I think that if you just look at the business capex numbers and you look at the jobs numbers, it's clear to me that we're going to see a recession in the U.S. and a deeper recession in Europe. And when you look across to Asia, the Chinese credit impulse, consumer credit impulse, is not responding to lower rates because the Chinese household indebtedness is now a little higher than U.S. household indebtedness got prior to the global financial crisis. So it seems to me, Adam, that we're at a place in time in which we're going to have a bit of a pullback. Now, markets always anticipate pullbacks, and you and I both know we've seen about $38 trillion taken out of global equity and bond markets in 2022. So maybe the worst of it's over. I think you're going to see the Fed continue to stay aggressive, and they're going to be hiking rates into a recession, which is something that you don't normally see, but they are hell bent on trying to arrest this inflation dragon before the midterms. And so I think they're willing to cause stock market declines in the face of kind of trying to arrest inflation. So all in all, when you look at all of the indicators point down, the question is, how long will they point down? Will it be a year? Will it be a year and a half? Will it be 2 years? I think it'll only be about a year before you'll see the Fed cutting rates. So I think the term structure of the bond market is actually got this called just right.
Okay. All right. Well, interesting and good to hear. That's maybe slightly more positive than some of my recent guests. So I'm actually really interested to dig into this with you. A lot of things to dig into in what you just mentioned. Let's start with your comment about the Fed trying to get inflation under control by the midterm elections. They're only, it's a little bit less than 3 months away right now. Is it realistic to think that they can really move the needle all that much on CPI between now and then?
Yeah, I think CPI is less relevant than people going to the gas pump
and how people feel, yeah,
and how they feel, and you've started to see the polling, start to really get better because they have now, I think, 70 or 71 days of nothing but fuel price declines. Now, that is likely due to the fact that the administration's been selling the Strategic Petroleum Reserve every day. They're selling 1 million barrels a day. The question is, are they selling it in the paper market or the physical market? You have the Saudi oil minister and OPEC Plus saying there's a divergence between the physical market and the paper market that they're not going to stand for. And you have the Biden administration also, again, not trying to be political, but to pull off the triple Indy, going and doing a deal with Iran to spite our long-term partners in the Middle East, the Saudis, is not going to be beneficial to this fuel price scenario. So I think they're trying to juggle too many things at the same time. But the one thing they've been able to achieve in the last 70 days is lower gas pump prices. And I think that really factors into the psyche of Americans.
All right. And again, I guess, what matters most is how people's psyches feel when they walk into the voting booth. And absolutely lower, fuel costs help. That being said, I think we're still seeing, high energy costs in terms of like electricity and gas for heating people's homes. Certainly food price costs are still elevated. Housing costs are still, rent increases, all that stuff's sticky. That's not going to come down anytime soon. So I guess I'm just sort of speculating here, but it seems challenging that they may get people's overall level of cost of living, their attitude toward cost of living, shifted materially enough by November. Certainly could be wrong, but I'm just curious what you think about that.
Yeah, when you look at housing in the U.S., there's some alarming statistics for the July numbers. The MLS reported that there were 5,962 new home closings in the month of July. That's the second lowest total ever in the history of reporting the MLS for the month of July. The only one that had a fewer number was July of 2007, at, call it, 4,700. So the average sales price on a home fell 7.4% month over month, not year over year.
Yeah, isn't that crazy?
Median sales price was down 4.5% month over month. So what you're seeing in U.S. housing, and evictions were up 300% month over month. So the higher energy prices, higher fuel prices, and a housing market where you've raised rates so aggressively from zero to where we are today has caused a shock in the market. And what you're seeing right now is just kind of that air gap that I think will metastasize in the next few months. So while you might have pump prices coming down, you're affecting real economic indicators with let's just say, being too aggressive on the monetary tightening side. So look, that's why it's certain that we're in a recession. We had 3 million new jobs in the last year, and yet you didn't see any productivity growth. So we're kind of having a recovery where we're adding compliance jobs and we're adding diversity jobs, but those jobs aren't generating additional sales or additional margin. It's actually a cost to the companies.
Right.
So I think those 3 million jobs were, LGBT inclusion jobs and compliance jobs, and jobs that actually are counterproductive to, let's say, the economy.
If you enjoyed this video clip, click here to watch another one you should like.